Hello, everybody. My name is Stephen Mead with Domicile Real estate for people who love houses. This is our Southern California housing market update for September 21st, 2021. And before we start, I want to talk about something because somebody noticed this, and I realized I hadn't really mentioned something of it. You might have noticed that a little bit of our conversation about the market has changed the last couple of months. Pretty much through the pandemic and through the spring, a lot of what we were talking about was, is the market up this week? Is the market down this week? And we're still talking about that in terms of relative competitiveness. But something that I wanted to mention, and we've shifted the conversation a little bit, is instead you'll notice we've been talking about the terms of rational and irrational markets, steady or unsteady market, dynamic or static market. And why we're kind of switching that terminology around is pretty simple. I think we're heading into a market where one of the things that we're trying to figure out, right, and something that everyone's trying to figure out is now a time when people are being sane, rational, and normal. Do we have a sense of a normalcy to our market or not? And that's really kind of a barometer for a lot of people of, is this a good time to jump into the market for me or not? I think, sometimes trying to predict these ups and downs, I mean, sure, we definitely had some weeks that were, in my opinion, particularly tough weeks to buy a house, especially this spring. But I think now that kind of some of that has subsided, I think now we're really talking about, are we kind of seeing the market moving in a direction that we want it to move in? I'll add another fun little anecdote. La Habra is a city here in Southern California, and I'm fortunate enough to know a member of the city council in La Habra, and he sent me a video of the La Habra City Council meeting, which I will not show here. It's very embarrassing for some of the people on it. But basically, the City Council of La Habra had concluded in their vast economic knowledge that housing no longer responds to supply and demand, that supply and demand no longer governs home prices. That's completely wrong, in my opinion. Demand and supply very much govern housing prices. But I've often noticed that when you're an economist, I think there's a lot of temptation when something doesn't work out the way you expect it to, or the market doesn't respond in a way that you expected, to conclude that the theory is wrong. But in my experience, what is more likely to be the case is that it's not that supply and demand laws have been violated in some unforeseen manner. It is merely that we have not figured out exactly what supply and demand are. In that case, we have not defined them and understood the forces working within. So I want to give you just a little bit of kind of words to two pieces of advice this week, and we're going to jump into these statistics. Number one, understand that I think in many cases, understanding the nature of the market versus being rational or irrational is more important than even understanding whether it's up or down. And two is that, supply and demand are pretty robust. They do work. Just when you see something you don't understand, it doesn't mean the theory is wrong. It means you are misunderstanding how to apply it. And a lot of times whenever that happens, I dig deeper and be like, okay, what am I missing in demand? This it's reacted in a funny way. What's going on that I'm not taking into account? So with that said, let's jump in and let's talk about the kind of market that we're in and how that might be actionable information for you. So let's get this on here. So first off, we're going to talk about active new listings. And I want to tell people something that's really important. If you notice, we kind of hit a peak of active listings in August. And if you look, it's a pretty gentle sort of a decline. This is 100% normal. Generally speaking, our inventory declines as we head towards the end of the year. It doesn't mean that the market is taking some bizarre turn. That's actually a very normal reaction, and one that, frankly, I'm sort of delighted to see some sense of normalcy. I think normal markets are a lot easier to operate in than abnormal markets. Now, if we move on here, right, and we take a look at, let's look at our new listings hitting the market, right? And one thing I want to mention briefly is this is the first week, because these stats are through noon today, where we are not counting any of Memorial Day weekend anymore. We are past Memorial Day Monday 2 weeks ago, right? We're past that figure. So I've talked a couple times that, there's some aberrations, some artifacts in the data when you have holiday weekends. And look what happened. New listings did bounce back up a little bit in both of our price categories, under a million and 1 to 2 million. Now, if this is our supply, right, of the market, if we're checking this out, let's see here. If this is our supply in the market, what is our demand? That's new escrows. And look, those also took a little bit of a bounce back off these lows. And if you look here in this graph, I know especially this under 1 million, I'm asking you to kind of extrapolate a lot here. But if you take a look at this, you can kind of see that things peaked. And one of the things I've talked about is, my theory here on this is that the real market we were in, demand actually looked like this and then started going like this, right? And the reason why it didn't look like this, though, is because we ran out of houses to sell, meaning this is kind of like a curve with the top part of it just shaved off because we hit this hard limit where we just didn't have any more houses to sell. And then if we had more houses, we would have seen more houses go into escrow back here in, February, March, April timeframe. But if you look at this, this is a very gentle downward trend in demand, which is exactly what we would expect to see as we head into fall. And frankly, exactly what you expect to see, when you hit kind of a peak limit of things, of the market meeting sort of these new conditions. I personally think all throughout sort of 2020, houses were largely underpriced and the market was racing to get to the correct price point. Now it's largely gotten there aside from inflationary effects. And that's why we're kind of seeing this sort of gentle decline in new escrows. By the way, as an aside, most people think that real estate brokers love hot markets. Nope, wrong. What real estate brokers love are steady markets. Markets with rational behavior, markets that aren't moving super quickly. And the reality is that is the kind of market that we are in at the moment. It's still an inventory constricted market. It is still I would argue we are still in a market of brisk demand with a housing shortage, but we're not in crazy town anymore. And if you look at our absorption rate, right, guess what? Our under 1 million, we're in the high 80s. That is still a very brisk market, not quite a crazy market. And our 1 to 2 million is still maybe 81% or so this week. This is still a very strong market in both of these price categories. Don't let these downward graphs fool you. But, these are kind of a standard run-of-the-mill brisk market rather than a, oh my God, everybody's hair is on fire level market. Now, if we look at prices, remember, this is like taking a look in a telescope that is pointed to the past. What do we see? 4 to 6 weeks ago, we had price increases. Yes, totally felt that. And if you look, though, these are fairly steady increases, right? We saw big, strong springs, then steadier increases. I keep using the term inflationary price increases. That would mean in our case, somewhere in that 3 to 5% window, annualized. That's kind of the pace I'm thinking of. That is a very steady market when housing is appreciating as fast as everything else. Now, if we look at our still active percentage, this is another one of our little sort of harbingers of how tough is the competition out there. Remember, lower numbers mean more competitive, higher numbers mean less competitive. If we look at that, yes, competition did increase in the past 2 weeks. Not terribly surprised. Again, I want to talk this little bump here 2 weeks ago. I think that was a bit of a Labor Day weekend sort of reduction in competition. But here we are kind of back around this line here. That's really pretty normal to where we've been. You'll notice things got hyper competitive, then they got a little less competitive, and now we're just kind of treading water in this zone, which I think is it's a very steady state market. And I think if you are a buyer or a seller, really this is the least level of risk in a market like this. Now, I've talked about our close to list ratio, and that what this means is this really is talking about that disparity between what sellers think their house is worth and how confident they are, and what buyers think they need to pay to get a house. And so whenever you see this situation of 104%, like over in this zone, what does that mean? That means sellers weren't even close to realizing what a hot commodity their house was. But now you'll see, as we predicted, we're heading into the fall, and this is marching down towards this 102%. I think we'll probably settle right around 100 zone, right? Where these prices are, that difference between where sellers are and where the buyer mindset is, that gap is narrowing. And really, that's a good thing. Markets with that huge disparity certainly might be fun for the seller, but they're not really fun for a buyer at all. Sellers are continually surprised by how much their house is worth, and buyers are basically continually surprised by how much over list price they have to pay to get it. We're heading again towards sort of a normalcy. And then if we look at days on market, this is kind of a fun one. We saw a little bit of a peak here. And I think the question I said, don't worry, the sky isn't falling. Back here in our under $1 million category, this week that number did reduce back. It is still, over 20 days. But let's be honest, at the end of last year, where was this figure for under 1 million? It was at 37 days, right? This number can go a lot higher and still feel like last year between now and the end of the year. So I want people to sort of understand that as a reference point and not maybe misread what they want to see in this graph, which is that the market is falling because days on market went up. If you look here in 1 to 2 million, that hit this kind of temporarily lull and then bounced back to kind of a zone it's been trading in for about, the last month-ish or so. I'll be interested to see if that is a trend line that goes up. I think it will be. And then finally, sort of our affordability graph. And I cannot emphasize how important this graph is if you are wondering, am I staring over the edge of a housing cliff? I also want to say something else. I'm reading a book, I might have mentioned it last week, called The Psychology of Money. I think it's a great book. I kind of encourage everybody to read this. It really kind of gives you an understanding of how the human mind interacts with financial decisions. Anyway, one of the points made in the book is that pessimism sells and bad news sells. And I'd rather give you the information I think that is accurate. I am not trying to sell newspaper copies here. And when I see this graph, this affordability chart, gosh, the fact that we have been riding in this zone for 3 months of payment levels. And just as a reminder, this is the payment on a median priced home as referenced back to June of 2018. And if you do that, what you notice is that we are trending right in this pocket of 110 to 115%. So 10 or 15% higher than the payment on a median priced home was in June of 2018. Gosh, that is almost 3.5 years ago. I definitely think median family wages have moved up this much. And this is the reason why I personally don't feel like this is some overpriced market that is awaiting a correction. We were underpriced, and look what happened. This affordability number went up, and then it kind of hit in the zone, and then this is where it has been since for 6 months we have been trading in this pocket for housing. That is not by mistake. That is the market sort of finding its equilibrium point. And that's exactly what's happened here. Finally, just as a reference, prevailing mortgage rates, something that is powering this affordability chart. If you look here, we are still just, again, very steady pretty much since the 4th of July through now. So over 2 months now, we've had very steady mortgage rates. This is what's contributing to a lot of our stability. So do understand, should those prevailing mortgage rates become unstable, that could have a destabilizing effect on the housing market as well. So that's kind of my disclaimer. Anyhow, thank you everybody for watching. Something special coming up this week. We got to just edit the video. We have just a really cool listing. And if you're an architectural nut like I am, you will love this house. And the best thing about this house is that this home is priced in that entry level zone for pricing. It is well under $1 million, means it is affordable to some first-time home buyers. It's also affordable to maybe first-time move-up buyers coming from a condo. So we are very excited to share that with you. I think in a market like this, when people are happy to get a house, any house, I think it's really cool to be able to give somebody, truly what I think is, in my mind, this is a dream house. This is something worth getting excited about. And we're super happy to bring that to you. So we'll be posting it up on YouTube and probably. So yeah, stay tuned for that. Don't forget to like, subscribe, click that like, subscribe, and hit that notification bell. Questions, comments, we love those too. And we will see you later on this week, as always, for our first time or entry level home buyer market update. We'll see you soon.